So let's jump into SA equities. What we're showing you here is a price to book chart of a basket of SA Inc. holdings that we hold within the PSG asset management funds. So this is not a broad-based index. All of these companies we've very carefully vetted in terms of our 3M process. We've applied our quality checklists. What this kind of environment allows us to do, just looking at sentiment, this is a price to book chart going all the way back to 2002. And we see valuations as low as they were post the collapse of the dot-com period and the global financial crisis. So we're able to, within this segment, look for what we deem to be high-quality businesses, many of them with long-term track records, very strong management teams. So we deem these to be actual above-average quality businesses, but the expectations are just extremely low that we will ever see earnings growth from these businesses, given that they are SA economy facing. Maybe just a couple of names. We have Udeco and AECI there. Those are examples of two businesses that have been around for over or close to 100 years. They've proven time and time again that they are able to navigate market cycles. Supergroup most recently reported double-digit earnings growth. We just think the market, given the overarching negativity, is just failing to take notice. Some other high-quality businesses as well, Nedbank, FirstRand, we think those are very well positioned to take advantage of an improved macro backdrop. Looking to South African bonds, it's very important when assessing any nominal bond investment. You have to take a look at the prevailing inflation environment that instrument is exposed to. But one thing we also just explicitly want to highlight is since inflation targeting was introduced in early 2000s, the SARB's actually done a very credible job to keep inflation well controlled. And over this period, and despite two significant exogenous shocks to our own inflation environment, again being the dot-com crash and the GFC, we've managed to average inflation at 5.7%, which is a very acceptable inflation rate. It means that inflation was well under control. Very importantly, about 18 months ago, the SARB signaled very clear intent that there are structural positive benefits to in fact actually re-anchor inflation expectations closer to the midpoint of their target band of about 4.5%, as opposed to just be bumping just short of that 6% target band. Just maybe looking at the last 12 months, that's resulted in inflation averaging about 4.6%. And looking at the SARB's forecast the next 3 years out, and we think it's quite credible that they'll be able to maintain these targets. We would have inflation at 4.9% over the next 3 years. Taking all of this together, 3 years forward, we would have had inflation average below 5% for 6 years. So we've spoken about inflation being under control in South Africa. We've seen that the SARB is very credible. Inflation expectations are being anchored to a lower point. But yet, looking at real yields globally and compared to our peers, the real yields in South Africa is discounting substantial pessimism. We've contrasted South Africa to Brazil. Brazil was downgraded to sub-investment grade at all the rating agencies during January 2018. We are still investment grade at Moody's. And we had a quick look in terms of just the potential headroom, looking at the Moody's rating scale for the debt to GDP measure. So we share the concerns around Eskom, but as a very extreme example, should the current South African fiscus absorb all the debt of Eskom, it would contribute about 7% to the total debt to GDP figure. Still less in terms of total headroom. And that's a very extreme scenario, as South Africa would only take on those payments as the payments come due. And those payments are stretched out actually over the next 10 years. The point is, we think the market is already reflecting significant pessimism. We're arguing there's actually some very strong structural underpinnings to our underlying inflationary environment. And we think this is a real standout opportunity for clients to harvest very strong real yields. We just maybe quickly want to unpack what we find is a very interesting opportunity within the South African government bond market. So how these instruments work, every year they will adjust your principal at the prevailing inflation rate, and they'll pay you a real coupon, which is currently 3%, and we think that's quite significant. But this is looking at 10-year inflation-linked bonds in South Africa. Current real yields on offer are above 3%. And maybe just some historical context, looking at nominal bond markets, close to an average result would have been to achieve 2.5% in terms of a real return, but you're still exposed to inflation risk within that asset class. So what we're currently seeing, a 3% real return, you're almost guaranteed an above average outcome, which we believe is very low levels of risk. In closing, just to give a sense for, what does a 3% real yield mean? At the x-axis at the bottom here, I'm showing you the SA government 10-year inflation-linked bond yields, and I'm contrasting that on the y-axis to the total returns on a 3-year annualized basis from the South African government bond inflation-linked index. And what we found historically, starting yields as high as they are today at 3% real, have subsequently transpired in annualized returns of about 12 to 16%. In terms of asymmetry, there's an equity-like upside potential, and we deem this to be at very low levels of risk.